Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. And we have an interesting one today from Joe. Hello Alan, I bought non-standard options by mistake. So this question is about buying options rather than selling options. In December of 2018, with Eldorado Gold, ticker EGO, trading at 97 cents, I bought the January 2020 $4 calls. The stock has moved up to near $8, but the options did not move. Once I learned about it, I looked into what they are. My non-standard options are for 20 shares of stock per contract. I still have time, but are they ever going to grow in value? What to do? And it's signed Joe. Well, on the surface, this makes no sense because a $4 option with a stock priced at nearly $8 seems to have almost $4 of intrinsic value alone. And yet Joe is saying that his options have practically no value. So let's review Joe's situation. Let's break it down and see if we can make some sense of it. So to review, in December of 2018, Eldorado Gold was trading at 97 cents. In essence, it was a penny stock. At the same time, Joe bought EGO January 2020 $4 calls. Now, since the stock was trading at under $1, a $4 strike price is deep out of the money. So although Joe didn't give the price that he received from buying, that he had to pay rather, for buying those options, we're going to assume it was less than 10 cents because the strike price was so far out of the money. Now we move on to October of 2019, almost a year later. EGO was trading at $7.83. Wow, what an appreciation on the surface. But the January 2020 $4 calls had virtually no value. Once again, on the surface, this makes absolutely no sense. Joe then discovered that he was owning non-standard options that represented only 20 shares per contract rather than the standard 100 shares per contract. Now, whenever we have non-standard contracts where there were contract adjustments, it implies that there was some kind of a corporate event that caused those contracts to move from standard to non-standard. Some of these events would include a stock split, a spin-off, a merger, acquisitions, and so on. So let's see if we could figure out what happened here and why those standard contracts became non-standard contracts with deliverables of only 20 shares per contract. So we did a little research. One of the sites I like to use is optionseducation.org. You put in the ticker for the stock you're looking for, EGO in this case, and lo and behold, it turns out that there was a 1-for-5 reverse stock split. So what that means is for every 5 shares of EGO that we own, we then will own only 1 share, but at 5 times the price. So stock trading under $1 would then be worth between $4.50 and $5, but we'd own only 1/5 the number of shares. So that's what a reverse stock split. Now, if you had a contract, an options contract with a strike of $4, that wouldn't be fair. So the Options Clearing Corporation would need to make adjustments on that contract. And as you could see from the screenshot, what was done is the contracts which went from EGO to EGO1 became 20 shares of deliverable stock rather than 100, and that compensated for the 1-for-5 reverse stock split. Next, let's have a look at a chart and see why a company would in fact do a reverse stock split. We know that companies that are doing quite well and the price is going higher and higher may do typical standard stock splits, 2 for 1, 3 for 1, 3 for 2, like that, just to bring the price per share down. And that would in turn allow retail investors to buy shares in 100 share increments. But this is the opposite. It's a reverse stock split. So as you could see from the chart, the stock went down substantially from 2015 until 2019. And so the price was looking rather poor. As I said before, it was a penny stock in essence. So to make that price look more attractive, window dressing, if you will, companies will often decide to do reverse stock splits. Not only that, but some exchanges require stocks to be worth a certain amount in order to be listed. So sometimes companies will do this for listing purposes. So in this case, there was a 1 for 5 reverse stock split shown where the double-sided arrow is. And so that would account for why the corporation decided to do the reverse stock split. So let's calculate now the moneyness of the $4 EGO1 strike. It's no longer the EGO $4 strike, it's the EGO1 $4 strike, which includes the contract adjustment. So a standard $4 strike contract, which would consist of 100 deliverable shares at $4, would be worth $400. But what about the non-standard EGO1 $4 strike with only 20 deliverable shares? In order to make 20 into 400, that means that we would talk about a $20 strike. So $20 times 20 deliverable shares would equal the $400, same as a $4 strike for 100 deliverable shares, in order to compare apples to apples. So now that $4 strike is really, in essence, a $20 strike. So with the stock trading at $7.83, that $20 strike is deep, deep, deep out of the money, and that's why it's worth virtually nothing. And so that would give an explanation as to why the price of the stock went up. It went up artificially due to the reverse stock split, but why the $4 strike did not go up in value, because in essence, with 20 deliverable shares, it was really the equivalent of a $20 strike. So if we took a look at an option chain for EGO, you would see where the arrows are that the EGO $4 call, which actually are created after the contract adjustment, in other words, new contracts based on the real current market value of EGO after the adjustment, was worth $4, which makes sense, because at $7.83, there's $3.83 of intrinsic value and 17 cents of time value. So that makes sense. But if we look at the EGO1 $4 call, which remember is the equivalent of a $20 strike, that has virtually no value. In this case, it's listed at a nickel. So I can understand Joe's frustration. Hey, wait a second. I bought this option and the price of the stock skyrocketed up to almost $8, and my option isn't worth anything. Kind of like I'm running on a treadmill here. And here is the reason why. Okay, so the $4 strike became a $20 strike because of the 1 for 5 reverse stock split. So let's summarize now this very interesting example here. Non-standard contracts result from some kind of a corporate event. Once I read Joe's question, I knew there had to be a corporate event because of the fact that there were non-standard contracts. Otherwise, the contracts would remain your typical 100 shares deliverable. Now, a reverse stock split artificially increases share value, but decreases the number of shares owned. So when the smoke clears, everybody is made whole. A $4 strike with 20 deliverable shares is equivalent to a $20 strike for a standard contract after a 1-for-5 reverse stock split. So what do we do in a case like this? We have an option that, in this case, that Joe purchased, and it's going nowhere. Well, you know, deep out of the money options, in addition to being worth very little, also will cost very little to close. So in a case like that, that would probably be the best path to take. Just close it out for a few pennies. And then if you're still interested in EGO as an underlying security, sell a more appropriate strike option or buy a more appropriate strike option based on the type of strategy that you're using. So, you know, really an interesting question. It doesn't come up that often, but it does come up from time to time. And when we see non-standard contracts, a bell should ring in our head that there was a corporate event that took place that changed everything. And we have to understand what that is. Now, sometimes contracts will change differently than deliverable shares. So, and they're all different. There's no one formula. So the best thing to do is to go online, call your broker, research it out, find out what that adjustment was and why, and then make your investment decisions from there. So Joe, thank you so much for that question. Very, very useful and interesting question. And of course, thanks to everybody out there for taking the time to watch this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.